In this video, we will look at parts of a simple income statement and explain what those parts mean to an entrepreneur or business. The financial sections of a business plan shows that the entrepreneur has a thoughtful plan for the business's current and future financial situation. Startup costs, operating expenses, and sales projections present specific information related to costs or sales. The income statement combines costs and sales into one financial analysis. An income statement shows when a business is expected to make a profit and how much profit that business is expected to make over the next 3 to 5 years. An income statement is a document that shows a company's profit or loss in a particular period of time. Profit is money that a business earns above what it costs to produce and sell goods and services. In other words, the company earns more from sales than it pays for costs. Loss means that a business or organization spends more money than it earns. In other words, a company pays more money in costs than it earns for sales. Now let's look more closely at the parts of an income statement. A simple income statement will include revenue, costs, and income. First, let's look at revenue. Revenue is the money a company receives, especially from selling goods and services. Revenue can be simply calculated. It is the total number of goods and services sold multiplied by the price of each good or service. Let me repeat that. Revenue is the total number of goods or services sold multiplied by the price for each good or service. For example, if an entrepreneur sells 100 pencils for $1 each, the revenue would be $100. Now let's look at costs. Costs are the money that has to be spent in order to buy, do, or make something. Startup costs only happen in the first year. Operating costs are the money that has to be paid for day-to-day operations. These costs depend on the product and whether it is a good or a service. Now let's look at income. Income is the money earned by a person, company, or government during a particular period of time. Profit has a very similar meaning, but is not during a particular period of time. Revenue minus costs equals income. Let's repeat that. Revenue minus costs equals income. For example, an entrepreneur sells 100 pencils for $100 in 1 week. That's revenue. The cost of producing the pencils is $60. The income for the week is $40. Net income is the total income of a company after taxes and other costs have been paid. In this definition, other costs often refers to costs like interest charges on borrowed money, not the operating costs like materials and supplies. Formal income statements usually include many details about revenue and costs and calculate net income. For this course, we will be using a very simple income statement. When income is negative, less than 0, the company has a loss for the period of time. Many startups have losses for the first 1 to 3 years, and in some cases even longer. Longer periods of losses often happen when there are extra costs. These costs can include buying big purchases such as machines, cars, or trucks. They can include high marketing costs, especially if the product is something new or different. Or they can include further product development costs to change the product to better meet customer needs. When income is positive, more than 0, the company has profit for the period of time. An income statement that shows income growing over time shows a company with a positive future. The financial section of a business plan often includes startup costs, operating costs, sales projection, and an income statement. This video reviewed the basic parts of an income statement: revenue, the number of products sold multiplied by the price for each product, costs, and income, revenue minus costs during a period of time.